So 2022 was the worst year in the bond market since forever. It was the worst bond year we've ever experienced. At least if you are comparing it to the Barclays Ag, which has been around since 1976, which really started the bond index. So dating back to almost anyone that's watching this is lifetime or investing lifetime and beyond, you just lived through the worst bond market of your life. Not only that, it was substantially worse than any year you've ever experienced. Last year marked the fifth down year in the bond market since 1976, so it tells you kind of expect one every, 10 years or so. And not only that, previously the worst negative year in the bond index was minus U.S. Barclays, calling that the bond index, was minus 2.92%. Last year's bond market was down over 13%. So your four previous times you were down in bonds was very little. Last year, historically bad. Okay, so let's understand why, and then let's look forward. So the why is critical. There are many factors. First of all, it's important to understand that bond prices and interest rates are inversely correlated. So when a interest rate goes up, a bond price goes down. Why is that? If I own a 2% bond at Coca-Cola, let's say, and I know that I'll get my principal back at the end of the term, and today interest rates are now 4%, and Pepsi issues a 4% bond, why would anyone buy the 2% bond? Well, in the open market, you really wouldn't unless someone offered you a discount. That therein is where the inversely correlated relationship happens. So, what did we see last year? So first of all, due to COVID and supply chain issues, there was a massive reversal of interest rates. The Fed said, hey, look, we're really concerned. Let's add more money to the supply chain. And they lowered interest rates to virtually zero. Thank you, my 2.25% mortgage that I have, which I'm very thankful for. Today, you see even your cash accounts are paying 3.5%. So today, it is not. You're not getting a mortgage at 2.125%, as we all know. So what happened? So then the little inflation had reared its ugly face last year. Started the year and we hit historically high inflation rates. The Fed has two mandates: full employment, check, we've been there for a couple years now, and 2% inflation. Well, when you see numbers at 7, 8, 9%, the Fed essentially went on an all-out attack against inflation. And in doing so, their biggest tool in their tool belt, their weapon in their arsenal, is to raise interest rates. That cuts the money supply at its throat. It makes borrowing harder and more expensive. It essentially slows the economy. And hence, what do you see happen? Inflation starts to come down, which is starting to happen. Now, if you're a bond investor, which most humans are, that's not a good state for bonds. They went into the year saying they'd raise rates 0.75% throughout the year. That's what 2022 started. The year ended, they did that in 4 consecutive meetings, 75% or 75 basis points. That's a big deviation from where they started the year. They went into the year saying, here's our expectations. Inflation went gangbusters. The market doesn't have time to catch up because it hit everyone like a ton of bricks, and they went out all out attack raising interest rates. Left holding the bag was bond investors. You couldn't catch up. New issues weren't even coming out fast enough to catch up. So in turn, if you owned bonds, it was a historically bad year in almost any bond sector imaginable. Okay, so you had inflation concerns, you had historically low interest rate, the Fed goes on an all-out attack, the bond industry was stuck catching up, interest rate and bonds, they're inversely correlated, net results minus 13% year in the bond market. Okay, So let's talk about where we're at today. The good news about the bond environment, first of all, we're expecting likely a 0.5% raise this year, and either 0.25% on either side of that, which is already priced into the market, and they're prepared. And if you do it systematically and slowly, it's not a huge deal for bond investors. It's the big jumps that we saw last year that really hit you. So, moving forward, the good news is seemingly the worst is behind us. You felt the pain. That has been felt. No hiding from it, but that's behind us. The good news is today, where we sit today, if you just look forward, is a fantastic environment for bond investors. New issue bonds are going to come at 5, 6, 7%. You're going to lock them in for a long period of time and have a pretty lower risk investment vehicle paying at historically high rates. So that's a really nice success story moving forward. May take a year or two to catch up for last year's downturn, but the full anticipation is you went through, you dealt through the muck, you trudged through it, and now greener pastures ahead. So you unfortunately had to get here, but from this point forward, it's a much rosier situation for us bond investors. So that's where we've been. That's what we're looking at forward. We're much more optimistic on bonds than anything this year. I think it's a great spot to be. And that's how we anticipate the future looking in the bond world, at least for the short term. Hope you enjoyed this. Hope you found it educational. I'm Andrew Rosen, President of Diversified. Stay wealthy, stay healthy, and stay happy.